Most people spend their lives trying to get out of debt, yet some of the wealthiest people on earth actively use it. That's the contradiction nobody talks about. A family takes a loan to buy a car. 5 years later, the car is worth less, but the debt remains. Meanwhile, an investor takes a loan to buy an apartment building. 10 years later, the property has doubled in value, tenants have paid the mortgage, and the investor owns a valuable asset. Same debt, completely different outcome. The difference isn't the debt, it's what the debt is buying. For centuries, debt carried a negative reputation. In ancient civilizations, unpaid debts could lead to imprisonment or even slavery. Governments eventually realized that taxing citizens alone wasn't enough to fund wars, infrastructure, and economic expansion. So they began borrowing, and that's where modern finance was born. Today, governments operate with trillions of dollars in debt. The United States national debt exceeds $35 trillion, yet investors around the world continue buying government bonds because debt, when managed correctly, can accelerate growth. The wealthy learned the same lesson. They discovered that debt isn't just a liability, it's leverage, and leverage changes everything. Imagine trying to lift a massive rock with your bare hands. Difficult. Now imagine using a long metal bar as leverage. Same strength, bigger result. Debt works the same way. A wealthy investor may put down $100,000 and borrow $400,000 to acquire a $500,000 asset. If that asset grows by just 10%, its value increases by $50,000. That's a 50% return on the investor's original capital. Not because the asset performed exceptionally, because leverage amplified the result. This is where things become fascinating. Throughout history, the richest families rarely focused on accumulating cash. They focused on controlling assets, land, businesses, real estate, infrastructure, assets that generated income. The average person borrows to consume. The wealthy borrow to control. That distinction creates an enormous wealth gap over time. And Wall Street understands this better than anyone. When interest rates fall, traders often rush into stocks and real estate because cheaper borrowing means more leverage and potentially larger profits. When rates rise, markets become nervous because debt becomes more expensive. History shows this repeatedly. During the financial crisis of 2008, excessive and reckless debt caused massive losses. But after the crisis, investors who used debt carefully to acquire quality assets during market declines generated extraordinary returns over the following decade. Now you may be thinking, so should everyone go into debt? Absolutely not. Bad debt and productive debt are completely different things. Bad debt takes money out of your pocket. Productive debt puts money into your pocket. A luxury car payment? Bad debt. A business loan that generates more cash flow than its cost? Potentially productive debt.